Good morning and a very warm welcome. It is lovely to have you join us this morning for the announcement of our 2022 full year results. Jose and I will take you through the presentation and address any questions at the end. Integrated thinking acknowledges the interconnectivity and interdependence of social, environmental, and economic systems, and recognizes that decisions in one area can have ripple effects across all aspects of a business. We embrace this approach at L2D to create long-term value and resilience while also contributing to a more sustainable and equitable world. One of the most topical debates in the retail space to emerge out of the COVID-19 epidemic is that of the relevance of brick and mortar retail and its ability to be sustainable in a post-pandemic era, particularly in relation to the super-regional centers. Remarkably, coming from 2 years or more of retailer closures, reduced operating hours, and disrupted foot traffic, we are seeing a significant shift in customer behavior back into our physical shopping environments. Month on month, we saw a steady increase in foot count and turnover across all our retail assets, outperforming the 2019 numbers. It would, however, be remiss not to recognize the predicament that we and our tenants find ourselves in, where this positive trend is being diluted by the realities of increasing costs due to economic pressures related to the power crisis, above inflationary municipal charges, and pressure on reversions. We are disappointed in the unsuccessful outcome of the Sandton VAB rates appeal and are considering our options to seek the right outcome. The stark reality is that rates per square meter at Sandton is now over 100 Rand a square meter. That is before you have done or traded anything. It is unsustainable and hurts our tenants and our shareholders in a very significant way. If you compare that to the cost of the electricity crisis, or if you add that to the cost of the electricity crisis, it illustrates how difficult it has become to do business. Jose will further unpack this. When we dive deeper into the results, we will unpack all these aspects of the 2022 financial performance. But taking a look at the highlights, L2D's operational metrics have shown good growth in 2022. The portfolio generated a 21.9% increase in turnover compared to 2021 and 18.3% ahead of 2019. It recorded a 24.9% growth in foot count compared to 2021 and 9.9% up on pre-pandemic levels. Higher demand for retail space resulted in improved retail occupancy rates and positive leasing outcomes, providing an enhanced customer experience. Portfolio reversions, while still negative, have considerably improved to minus 10.4% from negative 25.9% in the prior period. With the unsuccessful Sandton rates appeal, provision has been made, resulting in a net impact of approximately 2 cents per share on the distribution for the financial year ended December 22. This represents an additional circa 7% in distribution growth, which would have resulted in 13% growth on 2021. Despite the disappointment in this ruling, L2D is supported by a strong balance sheet, and we are pleased to report a full-year distribution payout for 2022 of 36.47 cents per share, which is an increase of 6.95% over the prior period. I'll now go through the detailed performance against each of our strategic value drivers, through which we measure the value we generate across the business. Let's start with our customer experience. Looking at the good turnover numbers achieved throughout 2022, particularly in the December period, it is clear that customers are leading the way back and driving our outlook for 2023. Customers still desire the personal interaction that brick and mortar offers, and it's important that we continue to elevate our physical spaces to create that euphoric experience for our customers when they visit our assets and spend their disposable income. In particular, the portfolio has generated 21.3 billion rand in turnover for the year, with Sandton and Eastgate combined contributing 64.7% to the total turnover. This is 21.9% ahead of last year, as I said, and 18.3% ahead of 2019. Luxury remains one of our best performing categories and still plays a large part in differentiating the L2D portfolio, and more specifically Sandton, from our competitors. What has also emerged is that luxury brands does not only drive the performance of the portfolio, but it also supports it in total. Excluding the extraordinary impact of the luxury category, the portfolio is still up by 21.1% year on year and 13.1% on 2019. So you can see how the whole system has improved significantly. Our camera system counting feet are impacted slightly every time load shedding kicks in for a minute or two. So these numbers are impacted to the downside by that. Here we go. Here we come, our caroling. Get ready. Here we come, our caroling among the leaves so green. Here we come, our wandering so fair to be seen. Here we come, our caroling among the city lights. Here we come, our caroling from day until the night. Love and joy come to you, and to you your Christmas too. And we'll bless you and wish you a happy new year. And we'll wish you a happy new year. Such fun watching that. The activations across the centres over the festive period were very well attended. Sandton City hosted the Festive City together with iconic brands Lego, Disney, Cadbury, and Chuckles. Festive City entertainers also provided performances at the various Sandton City courts. Sandton achieved monthly trading density of 7,301 Rand per square meter for November, influenced by Black Friday, and nearly 10,000, 9,976 Rand per square meter for the month of December, significantly above the centre's annual average of 6,286 Rand a square meter. That outperformed the Kleur super regional benchmark of 3,828 per square meter, which is higher by 64% for the same annual period. Eastgate hosted an immersive Christmas Colorland with foot count on the Christmas day higher than the previous 4 years. A festive wonderland was brought to Midlands, while Promenade got their hands dirty with a festive kitchen. These activations assisted in attracting customers and driving the turnover for our tenants across the portfolio. We continue to see a rise in foot count with over 74 million customers visiting our malls in 2022. In the fourth quarter of the year, the foot count growth started to normalize post the pandemic, with travel once again being a popular December experience. Retail has continued with demand for home deliveries with Black Friday and Christmas shopping seeing increased online spend. This, however, only makes up between 3 to 5% of the total retail spend in South Africa, indicating that customers continue to seek the blend between the convenience of online and the experience of the touch and feel that in-person shopping. The foot count across all quarters has surpassed prior year levels now, and maintained levels ahead of the 2019 quarterly average. Our super-regional centres, along with Nelson Mandela Square, have achieved double-digit growth compared to the 2021 year across all 4 quarters. It has been encouraging to witness the return of customers to Nelson Mandela Square, taking photos with the iconic Nelson Mandela statue, enjoying the beautiful art sculptures on the square, and frequenting the restaurants once again. LTD's hospitality assets posted a good recovery, buoyed by the removal of the last of travel and gathering restrictions. Sant & Son performed well throughout 2022, exceeding occupancies achieved in 2019, resulting in an average occupancy of 74.8% compared to 66.8% in 2019. Increased demand led to higher occupancies and improved efficiencies in operations, resulting in an average revenue per available room, or RevPAR, of over 1,300 Rand for 2022, above the levels we saw in 2019. The Sandton Towers resumed trade in August and ended the year with improved occupancies, with the main contributors being the ANC Electoral Conference and the German Embassy event at the Sandton Convention Centre. The average occupancy for the 5 months was 36.5%. The Garden Court ended the year exceeding 2019 levels in December. The full year occupancy average was 52.9%, compared to 72% in 2019 and 19.1% in 2021. The Sandton Convention Centre is steadily gaining traction, with a total of 195 events hosted in 2022 compared to 313 in 2019 and 63 in 2022. You can see how that momentum is starting to return, and we are seeing a return of major expos with their 2023 dates secured. Let's move on to the tenant experience. As I noted earlier, the portfolio experienced significant growth in turnover, with all 4 quarters of the year achieving double-digit growth year on year and maintaining an average ahead of the 2019 quarterly turnover. This is probably the last year we'll refer to 2019, as we now have returned to normalized comparatives. All our retail centres have surpassed 2019 turnover levels, with significant year-on-year improvement. Trading gained momentum as the year progressed, with turnover in the Q4 up 14.6% on Q4 2021. The December trading period was particularly exceptional, with Sandton in particular generating 1.25 billion in turnover just for the month of December. Following the same trend as our foot count, January 2023 achieved turnover 9.6% ahead of January 2021. When we look at trading density, we see that the graph illustrates a comparison between the portfolio performance versus the Belinda Kleur benchmark in both annual trading density and annual trading density growth. The portfolio was more severely impacted over COVID-19 period due to the negative impact on our super regionals, hitting a year-on-year low of negative 15.8% in February 2021. But as the lockdown levels eased, it has shown strong recovery, moving back into positive territory from July 2021 and continues to perform way ahead of the benchmark. In 2019, the portfolio annualized trading density growth, along with a benchmark, were tracking below CPI, indicating continued pressure on the retail sector even before COVID-19. This pressure was exacerbated by the lockdown restrictions. However, in 2022, the portfolio is tracking well ahead of CPI as well as ahead of its 2019 levels. The portfolio's annual trading density continues to show impressive growth, achieving 17.8% ahead of December 2021 and 15.6% compared to 2019. The category shows us interesting information. The categories displayed on the slide represent the top 5 categories in terms of their contribution to the portfolio turnover. These 5 categories represent 70.6% of the total turnover and 61.1% of the total retail GLA. Food services, one of the hardest hit industries during the pandemic, has now surpassed pre-COVID levels, trading at 15.5% higher per square meter than pre-COVID. Both fast foods at 14.7% and restaurants at 15% are ahead of the 2019 levels, and fast food is seeing a greater improvement in its trading density as customer preferences shift to more convenient food offerings in some cases. This being said, the cost involved in availing food services on home delivery platforms puts further pressure on the tenants' profit margins and affordability, and we are watching out for that carefully. Entertainment or family centers is another category not referenced in the slide, but was very heavily impacted by the pandemic and largely made up of cinemas that has seen good recovery, with Ster-Kinekor exiting its business rescue. The cinemas are trading 21.8% ahead of 2019 densities, with the overall category surpassing 2019 levels by 2.6%. There are only a few categories still trading below pre-COVID levels. That include department stores, and they account for about 19.8% of the total turnover. Over the past years, there has been a shift in the demand for department stores, as we have all witnessed. In 2019, its turnover contribution to the portfolio reached as high as 30% and now only represent 17.8%. As part of the leasing initiatives that will be discussed later in the presentation, we have engaged our tenants on right-sizing their boxes so that we can extract maximum value from their space. If we look at occupancies, the retail occupancy for December, at the end of December, was 97.9%. In June, it was 97.2%. And in December 2021, it was 96.8%. So we continue seeing some improvement. Including pre-lets, the retail occupancy improves to 98.3%, and that remains well ahead of the Q3 benchmark for MSCI of 94.3%. You would have heard me say many times that we like around 1.5% to 2% of vacancy because it allows us to do things like right sizing and get our tenants in the right place. The portfolio super regionals, Sandton and Eastgate, Sandton at 99.1% occupancy and Eastgate at 96%, maintained a combined occupancy of 97.6%, ahead of the Q3 MSCI super regional benchmark of 94.2%. The office portfolio remains under pressure with an occupancy of 80% at December versus June at 83.3%. This decline was due to the sale of the fully let 5 Simmons Street Standard Bank building. If we include pre-lets, the occupancy improves to 80.5%. On a like-for-like basis, the overall occupancy has improved. For offices, the management team remains focused on office letting with various strategic measures in place, and as a result, Atrium on 5th and the NMS offices saw encouraging leasing activity, filling approximately 5,000 square meters of office vacancies. The combined occupancy of Atrium on 5th and NMS was 77.6% in December 22 versus 68.7% in December 21. So there's been a huge improvement. We are pleased to welcome Southern Sun in their new corporate head office here at Nelson Mandela Square this coming week. We did a lot of leasing activity. 79 new retail deals were concluded in the year, equating to approximately 14,000 square meters. 76 of them are open and trading, and 3 are opening in the coming months. These new deals include luxury tenants Versace, that opened this last week Saturday, in a larger footprint store, and Balmain at Sandton. And Eastgate is introducing a new entertainment offering called Nitro Park. The new deals in 2022 were largely made up of tenants in the apparel category, filling 5,800 square meters of retail space, followed by food service of 1,897, homeware of just less than 1,500 square meters, and technology just over 1,000 square meters. Apart from attracting new tenants to our centers, we continue to see current local and international tenants investing in their stores to ensure that they align with their newest designs and offerings. These tenants include Zara, Gucci, Louis Vuitton, Dolce & Gabbana, Burberry, and Salvatore Ferragamo. I can't wait to see what these new stores will look like. I will now hand over to Jose to take us through the financial outcomes.
Thanks, Amelia. Good morning, everyone. The financial outcome for the 2022 year is positive, albeit that some of the shine has been dulled by the outcome of the Valuation Appeal Board hearing. A cost base increasing ahead of inflation and an income growth outlook that remains challenged by continued economic pressure compounded by uncertainty caused by unstable energy supply and increases in living expenses for the already strained consumer. Net property income after removing lease straight lining is up 7.27% compared to the prior year. This has been driven by property portfolio revenue, which is up 9.6%, and benefits from healthy escalations for in-force lease income, which remains higher than 6% average across the portfolio. Additionally, we have seen increased turnover rentals and higher parking income on the back of increased mall visits and longer dwell times. Property operating expenses increased by 12.8% compared to the prior year. This includes the reversal of some 33 million in credit loss provisions, which are supported by a lower arrears book and improved collection activity across the portfolio. The negative impacts being attributed to higher diesel consumption and increased provisioning on the rates expense line for municipal valuations. It is important to note that though a VAB decision was only received on Sandton City, this outcome also informed our provisioning for rates on Nelson Mandela Square, where the appeal process is ongoing. The combined expense impact of these two items on the 2022 results is some 67 million on a gross basis. It would be remiss of us not to emphasize that rates and the consequential impact thereof on cost of occupation is growing at an unsustainable rate. We will unpack the NPI contributions per category of income on a later slide. On the back of marginally negative valuation outcomes, as well as the sale of the Standard Bank building, the asset management fees we have collected remains flat when compared to the prior year. Head office operating costs were 7.9% higher than the comparative 2021 year, primarily driven by a combination of inflationary cost adjustments, early retirements, and depreciation of our office fit-out at Nelson Mandela Square. The expense line benefits from the reversal of share-based incentive payments for shares due to vest in 2023, but forfeited as performance conditions will not be met. Net interest expense for the year increased by 12.13%. This increase was primarily driven by bank fees on the refi done in the third quarter, which increased our hedge ratio and debt expiry as well as interest rate hedging expiries. The impact of the higher fixed rates will be more pronounced in 2023. Fair value adjustments on the investment properties of 106 million rand are partially offset by a positive 18.9 million rand mark-to-market on interest rate hedges. These are included in the profit before tax line. The taxation expense of 5.5 million resulted from a temporary difference on the deferred tax asset unwinding. This has resulted in distributable income growth of 6.95%, whilst funds from operations are up 3.2%. The funds from operations includes the impact of antecedent earnings relating to our treasury shares of some 14.5 million rand and the impact of deferred tax asset reversals of 5.5 million rand. Net property income, excluding lease straight lining, increased by 7.3% to 568 million. In terms of NPI growth per sector, we have provided a comparison to the prior year as well as to 2019. While the NPI has shown good growth of 7.3% on the prior year, it remains 21% below pre-COVID levels. The retail sector remains the core of the portfolio, contributing 83% of portfolio NPI and showing marginal growth of 0.3%. There are a few key themes that underpin this outcome. The average lease escalations remain in excess of 6%, which is coupled with a healthy improvement in credit loss provisions. These benefits have been largely offset by the impact of lease reversions and rebasing over the last 2 years, as well as the increased cost associated with load shedding and municipal cost hikes. You will note in our data that the retail portfolio's comprehensive cost of occupancy has decreased from 14.9% in 2019 to 12% in 2022. And although this speaks to a more sustainable rental base, it is worth emphasizing that the landlord's proportional slice of the money spent on occupation has decreased over the same period. The hospitality sector has continued to show signs of recovery with increased occupancies at the Garden Court and Sandton Sun and Towers, as well as the increased amount of events at the Convention Centre. NPI from the hospitality assets was 33.1 million rand for the year, which is a good improvement on the prior year. The office assets remain under pressure, and the recovery in our office exposure remains muted. We remain prudent in managing our capital. This is done to protect value during the current uncertainty and create a platform to deliver sustainable operations and position the portfolio for growth over the medium term. A sizable amount of our capacity is now earmarked for investment in renewable energy and initiatives that create further efficiency in the portfolio. The yields on these initiatives are accretive to the portfolio as we aim to implement them over the next 2 years. Our loan to value of 24.42% is healthy, and interest cover of 2.95 times remains well within the banking covenant requirements. Proceeds from the sale of the Standard Bank building was effectively used to fund capital expenditure in the balance of the portfolio. 850 million of term debt, which expired in the second half of the year, was successfully refinanced. As can be expected, this came at a higher interest rate cost, whilst we also opted for longer durations in the debt maturity and interest rate hedging profiles in alignment with our policy. The resulting debt and interest rate hedge durations increasing to 3.42 and 3.25 years respectively. As at the end of the year, 80.27% of our interest rate exposure is hedged. The average cost of debt as at year end is 9.23%, with total unutilized credit facilities of 340 million rand being available to the business. L2D's investment properties were valued at 8.2 billion rand at year end, after a valuation adjustment downward of 106 million rand, whilst having capitalized 90 million rand of spend in the portfolio. The valuation adjustment represents a marginal 0.33% increase on the June 2022 valuation and a 0.39% decrease on the December 2021 valuation on a like-for-like basis. During the year, we have bought back 24.7 million rand worth of L2D shares. The buybacks are currently on hold, and we do not expect to buy back any further shares during the upcoming year. South Africa's energy crisis has intensified over recent months, and this has significant impact on our portfolio. From an operational perspective, all properties have full backup generator power except for Botshabelo, where the large anchor tenants do have their own generators installed. This allows our retail environments to continue to operate fully during load shedding. However, this does come at a cost. Currently, on average, it costs us 4.5 times more for diesel than purchasing electricity from Eskom per kilowatt hour. This results in a cost per hour of around 35,000 rand at our average consumption and 64,000 rand per kilowatt hour at peak consumption across the portfolio. The resultant cost for the portfolio across the various stages of load shedding is indicated in the graph. Please note that these numbers are at 100% of the portfolio and not just the L2D share. We have implemented a number of initiatives to mitigate against the impact of load shedding, and these are covered in the next slide. The portfolio runs at break even at stage 4. Anything above stage 4, we start incurring significant losses for non-recovery in the provision of diesel supplied power. Good Spaces supports our strategy by prioritizing the key environmental sustainability issues facing our business by considering our short, medium, and long-term horizons and helping L2D adopt environmental best practices. In particular, in order to mitigate the cost of load shedding, we have installed a combined 3 megawatts of solar installations at Eastgate, Midlands, and Promenade, with a further 8.9 megawatt of solar installations in the pipeline across the portfolio. The solar plants are integrated with the diesel plants, which will reduce energy demand from the generators during the day. Together, these solar plants will save 16% of diesel cost based on the current energy mix scenario. Although we are slightly up by 2.3% on grid electricity compared to 21, which reflects a rebound in trading and activity, we are still down 15% compared to 2019. We are down 3% on our water usage from municipalities compared to 2021. Other focus areas for 2023 include the additional installation of smart metering systems for energy and water consumption to better track and recover these costs. The portfolio has achieved its net zero waste ready target at year end and is preparing for certification by the end of 2023. We are replacing water-cooled air conditioning systems for Midlands, Eastgate, and Promenade with air-cooled systems and a partial replacement at Sandton City. The Eastgate water harvesting project design has been completed and construction will commence shortly for completion by the third quarter of 2023. The Sandton City water harvesting project is near design completion and phase 1 is targeted to be completed by the end of 2023. We are seeing a steady decline in both water and energy consumption due to energy and water efficiency initiatives across the portfolio. 212 lease negotiations representing 44,000 square meters of space were concluded for the 2022 year. Of these, 195 were retail leases, with 17 being office leases. The retention rate for the 2022 renewals, including those under negotiation at the end of the year, was 84.8%, compared to 92.5% in December of the prior year. The decline is attributed to a few large office leases at Melrose Arch, which includes Wally Parsons, DuPont, and Bain & Co., and at Nelson Mandela Square, where Mitsubishi have not renewed their leases. If we exclude Melrose Arch, the retention rate in the balance of the portfolio improves to 93.7%. Reversions remain negative for the portfolio at minus 10.4% for the year. The trend, however, improved in the second half of the year from the minus 16.3% recorded at June of 2022. The retail reversions ended at negative 9.7%. Although the overall portfolio has shown growth in turnover, this is not the case for all tenants, and the timing of renewals further impacts the correlation of turnover growth to gross income growth. Additionally, the rising cost of occupying space as a percentage of the gross rental collected is increasing and thereby diluting NPI growth. Each renewal we do is assessed individually to ensure sustainable rentals going forward and with careful consideration to the comprehensive cost of occupation. The retail reversion of minus 9.7% equates to an average loss of 58 Rand per square meter across the portfolio for renewals done in 2022. This is an improvement on 2021, which saw retail revert by 26.1% negative, equating to an average loss of 130 Rand per square meter. Lease escalations across the portfolio remain healthy at 6.6% on average. As can be seen in the graph, rental reversions were already under pressure in 2019, with COVID-19 exacerbating the downward trend. Leasing initiatives over the last 4 years have resulted in rentals reset downwards to more sustainable levels. However, we are encouraged by the year-on-year improvement in the reversion rate trend to minus 10.4% overall in 2022. We believe the portfolio, rentals, and cost of occupation for tenants in our portfolio have rebased to more sustainable levels, boding well for rental growth in lease negotiations going forward. However, we continue to expect a lag between the improving operational metrics translating into rental income growth due to the contractual nature of leases and timing of renewals. Looking ahead for the 2023 year, there are 94,000 square meters or 11.1% of the portfolio of retail GLA up for renewal in 2023. We are obviously pushing for continued improvement in the reversions, so when taking a closer look at the current operational performance of the upcoming renewals, we estimate that these upcoming renewals have experienced a slightly better performance of 15.9% growth versus 2019 compared to the bucket of 2022 renewals for the same period. We have excluded luxury from the comparison due to its significant growth and weighting in the 2022 renewals. Although the overall performance of the 2023 renewals is positive, which will assist in the negotiations, we reiterate that this is not the case for all tenants in that mix. Department stores, for example, which constitute 23.7% of the total renewals, have not yet recovered to 2019 levels. However, the leasing initiatives include right-sizing these boxes to extract value from the space. As previously mentioned, the comprehensive cost of occupation, better known as the CCO, has become a focal point in negotiations, as it factors all costs payable and not just basic rental. When looking at a sample of the 2023 renewals, the CCO for these tenants at 13.9% has not yet recovered to the 2019 levels of 13.3% as a result of the rising municipal and utility costs over the past 4 years, which affects the affordability of renting the space. We continue to focus on our net zero strategy and in doing so mitigate the impact of these uncontrollable costs. I will now hand back to Amelia. Thank you.
Thank you, Jose. One of our key imperatives is to continuously assess our business to ensure we are efficient, effective, and impactful. Our people should therefore strategically align to the core pillars of our business being operations, finance, commerce, and human capital. With this said, it gave me great pleasure to have announced the leadership changes on SENS last week that is effective on the 1st of March. Jose has been promoted to the Chief Commercial Officer, not to be confused with the CCO, or Cost of Occupation. In this new role, Jose will focus on value creation by maximizing the income streams, focusing on strategic leadership and guidance on commercial negotiations, and manage large capital projects and investment transactions. Jose will remain on the L2D board as an executive director. Congratulations, Jose. I really hope that you will enjoy this new role and look forward to the value that you will continue to create. Jose has done a sterling job as financial director over the last 6 years and set a great foundation for the team. Barbara Makubedi, L2D's lead independent director until last Thursday, who is with us today, has been appointed as the Chief Financial Officer. Barbara is a chartered accountant with 20 years of experience in finance, auditing, tax, and acquisitions in the listed and unlisted environment. In her new role, she'll be responsible for overseeing finance and reporting, risk management, legal and compliance, IT governance, as well as investor relations. Barbara will remain on the board of L2D, now as executive director. I would like to welcome Barbara as a member of the L2D team. Peter Nelson, one of our directors, will take over as the new lead independent director. These changes support L2D's commitment to a focused transformation and gender strategy. The board is now comprised of 55% female and 45% male directors, 55% black and 45% white directors, and black female directors make up 45% of the board. I was serious last year when I said and made a commitment to transform this industry one action at a time and one woman at a time. To conclude, 2023 will present another tough environment. Notwithstanding the macroeconomic challenges, we remain steadfast in executing initiatives in support of our strategic value drivers. We have the benefit and privilege of world-class retail assets that have shown great resilience and remain in high demand amongst our tenants and shoppers. Our strategy includes a focused drive on cost containment, extracting value through efficiencies and considered capital allocation, including investment in renewable energy, modernizing our HVAC systems, such as I spoke about, and utilizing rainwater harvesting to defray continued excessive increases in utility costs. Improving on the muted office performance and recovery in the hospitality sector remains a focus for us. Overall, we believe the portfolio rentals and cost of operations and occupation for tenants have rebased to more sustainable levels, boding well for rental growth in lease negotiations going forward, remembering that it's not all happening on a straight line basis. We expect a lag between the improving operational metrics translating in rental income due to the contractual nature of leases and timing of renewals. Given the level of uncertainty in our operating environment, providing distribution guidance remains difficult and needs to be considered in this context. Based on our current forecast and assuming a 100% distribution payout ratio, we expect the full year distribution for 2023 to be between 0 and 8% up on the prior year amount. This is dependent on no further significant negative changes in the intensity of load shedding. If we stay on level 6, we cannot deliver this. Cost of diesel or the municipal rates valuations of the portfolio. Surviving tough times requires more than just survival instincts. It requires integrated thinking, as I said at the beginning. By connecting the dots between seemingly unrelated factors and embracing a holistic approach, we will weather the storm and emerge stronger than before for our people, our shareholders, our tenants, our industry, and all our stakeholders. This brings us to the end of the presentation. We'll take your questions now. Thank you.
The first question comes from Chris Reddy at All Weather Capital. Chris is asking you whether you can please comment on the performance of retailability in the portfolio. Are there further opportunities to reduce the GLA to the group?
As we noted in the presentation, department stores have not all recovered to pre-COVID levels, which is where retailability, or for those that are not familiar with it, is the company that took over Edgar, have traded. We are in continued negotiations with them to make sure we right-size their boxes. We've always said that space is too big, especially at Sandton, and our teams are working on making sure that we get those boxes right so that we get a better trading experience for them. They've put a lot of effort into this business, and we want to see them being successful, but also to take some of that space and give it for tenants that can trade well out of that space as well. It's prime space, and we will be getting some good tenants in there. Thanks, Dimitri.
Thank you, Amelia. The next question is directed to Jose. Given your appointment now as Chief Commercial Officer, what are some of the capital allocation decisions that could be done to reduce the discount to NAV that LTD trades at, particularly now that you are no longer buying back shares?
I think the discount to NAV is a complex one. That also depends on market views and how people perceive the share and trade the share. It's highly illiquid, as everyone already knows. I think the capital allocation decisions that we've got is to try and make or spend capital where it's accretive to the overall portfolio. And where we see the most value over the next 2 years is on spending on renewable energy, water harvesting, and creating efficiencies in the portfolio. All of those initiatives are yielding more than the assets currently.
Thank you, Jose. The next question comes from Pranita Daya at SBG Securities. Pranita's question is regarding the recovery rate on diesel costs, which she believes at 49% is quite low. What are some of the factors contributing to this, and are there a lot of leases that don't permit this on charge?
Yes, it's complex. The recovery rate changes depending on the level of load shedding that we do have It's dependent on what provisions have been made for load shedding in the leases and diesel utilization at the centers. Naturally, there's a lot more focus on this now than what there has been over the last 5 to 10 years. So the older leases have less provision for it than the new ones we are currently negotiating and implementing. Additionally, what's important is the ability to meter exactly what a tenant is using at a point in time. And we are introducing a larger allocation of smart metering across the portfolio to better track and recover this. It's important to note, though, that a large part of the consumption of electricity in the portfolio is in the common areas, and that'll have an impact on the ability to recover.
Pranita's next question is regarding the solar power installations and what the expected yields on these installations are.
When measured, it's different for the different centers, and obviously also will depend on the infrastructure required to do the solar. In certain instances, the roof structures that we've got don't need any further support. In other instances, there's large capital amounts that need to be spent on providing better infrastructure or rolling out steel infrastructure across parking lots to house the panels. But on average, the IRR, when measured over 20 years, is some 15% across the portfolio for these investments.
Thank you, Jose. The next question comes from Paolo at Clearance Capital. Could you talk to your capital commitments relating to One on Whiteley?
One on Whiteley is part of the One on Whiteley development at Melrose Arch that we have committed to buy once it's trading properly at 130 million rand, or 128 million to be exact. We are currently negotiating with AMDEC to get out of that commitment, and we'll see how that unfolds over the next few months.
Thank you, Jose. The next question comes from Mahir Hamdile at ABSA. Mahir would like to, if you can please elaborate on the Woolworths leasing outcome in Sandton City and whether this has been concluded today.
It's very near to final completion. We are still negotiating a few key points with Woolworths. The original lease was signed a very long time ago and didn't take a lot of the current realities into account, such as online trading, turnover rentals, etc. And that is being negotiated with them at the moment. But we will probably settle that in the next couple of weeks.
Thank you, Jose.
There seem to be no more questions at this point. We will be seeing most of you over the next couple of days on our one-on-ones. If you have any other questions, please feel free to send them through to Cementry or Terrier at investors@liberty2degrees.co.za, or give one of us a call and we'll be happy to take your questions. Thank you for attending our presentation today, and good luck for the rest of 2023. One can hardly believe that we're already at the end of the first 2 months. Thank you.